Hello, everyone, and welcome to part 3 of the Maguire was ESG webinar series. Today with a focus on ESG and global financial markets. A quick admin note, for those of you that require CLE points or applications, these can be made with this presentation today. And we trust that you've enjoyed the last 2 webinars from our colleagues in the ESG team at Maguire Woods, focusing on latest trends as well as litigation risks. I think what that does show is the bench strength that we do have as a firm in terms of the services that we can offer in the ESG space. But today, the focus is on something a bit closer to our hearts, the three of us. We're looking at the finance side of ESG services from a broad variety of angles. So I think it would be helpful as we progress. I'll give a brief introduction of myself and my experience, as I'm sure my colleagues Penny and Anne will at a later stage when presenting their pieces on ESG and loan documentations and a discussion on the capital markets. Slide. So my name is Mark Naidu. I'm a partner in the London office. If you have not heard from my accent, I'm actually from South Africa. My experience with ESG has been quite a long process, given that my experience as a finance lawyer has largely been working with DFIs as well as borrowers borrowing from DFIs. In terms of pure ESG experience, I lived in Ivory Coast for a while, working in the private sector team at the African Development Bank. I also was one of the founding members of Standard Chartered's Sustainable Finance team. I am an advisor to the EU on Blue Finance. I am also a co-author of the Middle East Sustainable Finance Principles, which were promulgated 2 years ago now. So my discussion largely focuses on my experience and my expertise in emerging markets. And when I say emerging markets, it's more Africa, because that's predominantly where my practice lies. And I wanted to give some insight into some of the things you should look for when trying to enter into these markets, in particular Africa, because I'm sure some of the audience here would be looking to do deals in Africa. And at the moment, the ESG wave, so to speak, has allowed that to be more accessible than ever. So if you look at emerging markets, and in particular Africa, there's always been a negative connotation with respect to doing deals there. And these come from things like political uncertainty, where changes of regimes could result in certain sponsors falling out of favor or even parastatal assets being seized. There's volatile industries. In particular, the one that I will mention is agriculture. And you'll hear me speaking about agriculture more in this presentation. But I think agriculture in any jurisdiction is volatile. It's cyclical in nature, and you're basically relying on external variable factors. And couple that with a jurisdiction which is regarded as high risk, it just makes it all the more cumbersome to enter into. And of course, there's collateral issues. Lenders, no one wants to lend when credit is protected by an asset that could disappear. So these are the challenges that we've had with deals in Africa, in particular representing borrowers trying to get onto the debt finance spectrum. But the emphasis on ESG has resulted in an opportunity that has arisen. And we'll discuss the mechanics of this opportunity later. But what we're seeing now in the market is that investors and financiers are seeing Africa in particular as a low-hanging fruit in terms of ESG transactions. And you may ask why. And it comes down to a growing population. The population of Africa in totality is expected to double by 2050. If you look at infrastructure, the electricity access rate for Africa as a whole is 40% throughout the entire continent. And that includes North Africa and South Africa as well, which has a high electricity access rate. And if you look at all these factors, infrastructure, growing population, the first 6 UN Sustainable Development Goals relate to social aspects exclusively. So that's even before taking into account environmental, the E in ESG. And so if you can find a place where you can hit all 6 of those UN SDG goals with projects, then immediately that presents your portfolio with tangible assets that can actually be different from what other ESG investors are doing, which is, as much as I'd hate to say it, is predominantly focusing on green or the E. And this includes with things like financial inclusion and with helping people in these environments. It also includes industries that would usually not see much love, and that includes agriculture, once again. But in order to understand the landscape around funding throughout Africa, you have to look at where the historic funding has come from. And immediately what we saw was that the task of developing emerging markets fell on DFIs, so that's development finance institutions, which I'm sure you all are aware. And the perception is that this debt was cheap, which was not the case. And it was an inside joke for the people that did work with DFIs. One of my clients once said to me that the DFI debt is the last resort, because amongst the covenants package, they'll probably ask to see the report card of one of your kids. And that's actually, it sounds funny, but it's quite true, because the covenant packages were very heavy and they were very laden with cumbersome policies that reputationally had to be there for DFIs. And that's also not even taking into account some of the more aggressive DFIs that would request equity in transactions as well. So the unintended consequence of this on the timeline was that it introduced cheaper debt from China. And it was borrowers looking to fund riskier projects would look to this parastatal debt. And if you follow the news, you'd see that a lot of companies as well as sovereigns have lost their assets to these Chinese lenders, obviously state-backed, because the ultimate end game for the lenders was never to get a protection of credit. It was more to get their hands on the asset. So even now you will see that there are ports, there are railroad stations, there are power plants that are all currently owned and operated by China. And that was because the way that the debt was given was unrealistic. They had different types of structures to repay, which were very novel and sounded great on paper, but they never worked, because you would have a split bullet tranches of repayments where the first tranche would be payable at a very early stage of operations of a company. And so, as I said before, it was the actual end game was never getting repaid, but it was always to get their hands on the underlying asset. So it leads us to the sort of fool me once mentality. And emerging market borrowers decided that cheap debt, as with all things in life, is probably the most expensive debt you're going to get. And they turned their back on these lenders, Chinese lenders, and they decided to focus more on the private sector, which has now been made much easier through the rise in ESG, the ESG agenda worldwide. So if you follow that timeline, where it leaves us is that there's now a gap in the market, and the gap is where we see these opportunities arise, and where my portion of this webinar is to kind of lead you to that gap in case there's a business opportunity there. And the gap is a middle ground between the covenant-heavy DFI debt and the collateral-heavy Chinese debt. But that being said, with the gap and obviously the debt being expensive, people would assume that the DFIs were sort of the evil financiers that were just overcharging borrowers. But it's nothing could be further from the truth, because there was a legacy that was left by DFIs in the market. And a lot of the foundation of what we see in current ESG terms have come from DFIs. And I'm proud to say that as a firm, we have been part of those teams that have drafted these clauses. And these include things like developmental outcome reports, which are pre-agreed schedules that form part of an information covenant on a transaction. The excluded activities list, which I'm sure all of you have seen, which includes prohibitions on certain lending activities into sensitive areas, for example, arms, gambling, unsustainable palm oil. The concept of margin ratchets, which I know our friends in the leverage finance market would like to think they created, was actually something that was a DFI-focused initiative, whereby there were ratchets on the pricing which were linked to certain metrics that were set, which I will touch on later, but Penny will focus on in her KPI section. And community upliftment clauses, which were things done that were not actually related to a project, but the adjoining area. So, for instance, building schools or building a football stadium. And these are things that the DFIs kind of brought to the market as a legacy of where we are at now in ESG. But what we're now seeing is, with that legacy, it does allow safe money, and I'll tell you what I mean by safe money, to go into these volatile industries in emerging markets, in particular Africa. And safe money, and this is from what we've actually seen in the market, is US and Canadian pension funds investing, as well as low-risk asset managers, almost treating these deals as fixed income assets. And the way that they've come in has been through the use of de-risking structures. And in terms of de-risking, there's two main types that I'll just touch on. It's blended finance, as well as pure de-risking guarantee-linked structures. And the way that the safe money is coming in is they are trying to supplant the gap left by the Chinese when borrowers stop looking at Chinese debt. So, de-risking and blended finance. Blended finance, just as a quick, I'm sure most of you know what blended finance is. It's where public debt and private debt partner up to invest or lend into a project. And the concept is that where there is public debt made available, the project then checks out, and it's almost a blessing on that project. However, there have been some issues with this approach lately, which we've seen with our clients that we've been working with. And a few of them is inconsistency with reporting standards. As I mentioned earlier, DFIs are very covenant heavy in terms of their information covenants as well as policy requirements. There's misalignment on pricing, and you may not know this, but it's actually more expensive on the DFI side than the private sector side in most cases in Africa. And many private sector financiers feel like they get price locked into deals that they're uncomfortable with. Another novel thing that's happened, which has unfortunately happened to me, one of my transactions, was that a lot of public sector funds are now being redeployed for COVID relief in Africa. And what that meant is where there was money available for these pots of blended finance, those are now have been taken away and have been pushed towards COVID. There's collateral considerations, which, as many people know, DFIs don't want collateral in terms of hard assets because they don't ever see themselves taking over an asset. So there's a mismatch in ideology there as well. And probably the most important is sell-down restrictions, because as we all know, once a financier lends, the first thing they do is to put debt into the secondary market, and your hands are tied in this regard because DFIs will actually have to give their blessing before you can do that. So that's not all doom and gloom, because what we've seen is the de-risking model being a pure guarantee-based structure, which seems to be very common in the market now. And there's a few transactions that we are doing which is following this model. The adage goes that for every $1 that is lent by the World Bank or a World Bank member group member is equal to $4 that's guaranteed by that group member. And that is arguably the most important way of crowding in capital into projects. And types of de-risking instruments include first loss guarantees, which is you take a haircut if there's a loss, partial credit guarantees, which is limited to a certain amount, as well as full guarantees. And if you're thinking of investing in emerging markets, I wouldn't say that this is a roadmap, but this is more of a compass to show you the way in which to approach this. And that's to look at these de-risking guarantees as the first port of call when wanting to enter into these transactions. It allows immediately more funds to flow through the structure, and there's a degree of safety in partnering with the DFI or public sector institution to structure the debt. So, quick, before I round up, just conscious of the time, some of the structuring considerations that you want to look at when doing a de-risking guarantee structure is, remember that the borrower is the one that arranges the guarantee, and it's usually backed by counter indemnity. So essentially there will be a guarantee for a sum of debt which will be payable by the DFI or public sector, and on the back end there'll be a counter indemnity that the borrower will make the DFI whole, well, to an extent, because I assume if they haven't paid the debts in the first place, there's not much luck under that counter indemnity anyway. The borrower will also have to act as a go-between between the DFI and the financier to ensure that whatever conflicting terms match up. And that leads me into the main thing, which is what is actually being guaranteed, because the first parameter of these de-risking structures is how much skin in the game the DFI is going to put in. And that will need to be agreed up front, and it has to be, as you're aware with negotiating term sheets, it is very important that everyone is on the same page with this, because we've had instances where on a note issuance, the principal was guaranteed, but then subsequent investors to that note were asking why the principal wasn't either. So something to bear in mind. And the fourth thing is what metrics are being solved for here? What is the problem that is being solved by this project? And remember that the reason why I mention this, and I know Penny will talk more about KPIs later, but remember when a borrower goes with a de-risking structure, you have two sets of covenants that you have to adhere to. You've got the covenants that come from the DFI itself, and you've got the covenants from your financier. So that goes back to matching up what the terms are, but it also goes on to have a clear understanding of what your project is trying to solve, or what your ESG angle is, and ensure that you have a set of covenants that covers you for both. The second thing is how much you need to pay the DFI. And I think de-risking structures aren't free. I'm sure most of you are aware of that. And usually there's a guarantee fee, but other structuring considerations would be an upside mechanic whereby at the end of the term, the DFI would share in a portion of the profits of the venture, or there would be a bonus fee for performance of the borrower. And lastly, you'd have to look where the payment is enforceable. And I think this is something that is quite a nuanced position in DFIs in Africa, and that's your natural instinct is that you would act on a guarantee once it becomes enforceable. And what we're seeing is that the repayment of the debt under the guarantee is being delayed until the end of the term. Whether it's a note, whether it's a loan, we're not DFIs are not putting money up front. So whether there's a default in year 2 and there's a 10-year term, the money will be paid at the end of 10 years. And that ensures that this issue of COVID relief and liquidity concerns is mitigated by the fact that there's no money up front that needs to be put up. It's treated as a contingent liability on the books. And that's something that needs to be taken into account when structuring these types of deals. So for me, just to wrap up, we discussed that there's a gap in the market that can be, I would use the word, exploited. And it's something that when you are looking to invest in Africa, you should probably give us a call. And we can guide you through these structures and also introduce you to the right people. Because as we said, as a firm, we're here for your entire journey on this ESG spectrum. But what you would need to know is that if you want more capital, it would make sense to go the de-risking route as opposed to trying to lend directly into a corporate. And also you get a layer of protection from the DFI. And as I said earlier, it kind of blesses your portfolio, if that makes sense. But as I said, please contact me if you want more information on structuring, if you have any ideas. More than happy to have a discussion and to talk you through it. Africa is not so scary to do business in, I can assure you that. I turned out fine. But with that, I will hand over to my colleague Penny. Thank you.
Thank you, Mark. Good morning for those of you in this time zone. It's great to have you all here. I'm Penny Zacharias. I am a partner in the firm's debt finance department in Pittsburgh, have worked on a lot of different loan structures for companies, financial institutions, and non-bank lenders, investors in the impact investing space over quite some time. So it's good to be with all of you. I'm just going to give an overview of a few different types of loan products in the U.S. markets that we've seen evolving over the last handful of years. So, we've talked about how many companies have adopted corporate social responsibility efforts and ESG policies, whether that's at the, request of their stakeholders or stockholders or investors for many different reasons and responses to regulatory and legal developments that have been evolving. And, for those reasons, we've seen, the consideration of these ESG principles in loan transactions is not a new one. I mean, project finance has been around for quite some time in the States, but there has definitely been developments that have pushed greater interest into loan transactions in the U.S., evolving with ESG principles. One of the things that has been around for a while, and Anne will touch on much more than I will just mention, is that we've seen sustainable financing products in the U.S. For 15 years now, probably, with the advent of green bonds that emerged in this market. And that market has grown significantly, but can be limiting for certain companies. The green bonds themselves, the bond market more generally, which has led to market participants turning to loan structures with the ESG overlay. So some of these newer loan products offer benefits that I will, that are up here now. For one, there are fewer disclosure and reporting obligations when you compare to some of those requirements with the capital markets issuance. The transaction costs generally are lower and therefore may be more suitable and more accessible for smaller companies. And the debt size and the loan structures themselves tend to be more flexible, again, could be way more accessible for for smaller companies and allow the borrower and the lender to really tailor the transaction to the company's sustainable objectives and the lender's commitment in that space. So the first product I'm going to mention are green loans. Very generally, a green loan is a loan instrument that's available to a borrower to finance or refinance a green project. Before we talk about the aspects of the loans themselves, the green projects have really been formulated by a working group comprised of LMA, LSTA, and APLMA representatives that published these guidelines, these green loan principles, which are really came about in order to provide an industry standard in the green loan market. I will say that participation with these principles is voluntary, but they were created to have a framework developed on the market standards, guidelines to have a consistent methodology within this market as it develops, and to also preserve the integrity of it. So one of the key tenets of green loans is that the use of proceeds of these loans has to be squarely within the objectives of an ESG. Here, the G has to be very clearly articulated within the loan documentation that the use of proceeds is going to be for a sustainable project. And the lender should work closely with the borrower to walk them through what the process for evaluating the project from the very beginning, even in the due diligence and deal sourcing time frame throughout the life of the loan, what that's going to look like. The company should be able to clearly articulate to the lender what its objectives are and how it's going to manage the proceeds, and even during the life of the loan report. So one thing that we see is that some companies dedicate a separate account for the proceeds to preserve the integrity. Could be a dedicated account to just keep that transparency throughout. And reporting can be done on an annual basis through a third-party, consultant or an auditor, or there are organizations just really focused within the ESG space to evaluate the impact of the project. These, I guess one thing as a note of caution, we hear this term used within the space is greenwashing, which is an attempt by some to just capitalize on the benefits afforded to companies in this space by marketing that they are, going to have an impact, a green impact, but are not really complying with the principles, which is another real benefit of the principles and this working group that works to evolve them. Because the principles have been refined over the past few years, every year or so revisited and built out. The next type of loan that I'm going to mention are sustainability-linked loans, SLL loans, sometimes called ESG loans, sometimes called KPI loans, short for Key Performance Indicators. These are loans that are, they serve to encourage the company's achievement of certain sustainability performance objectives. So, unlike green loans, they don't require that the borrower use the loan proceeds for a specific ESG project, but they're tied more broadly to performance. So there is a working group of the sustainability-linked loan principles were evolved by this, representatives from the same organizations, the LMA, APLMA, and the LSTA, to provide an industry standard for this segment of the market, to work with lenders to incentivize companies that are looking to improve their sustainability, performance, and overall profile. So these key performance indicators, which are really critical to these structures, can be external ratings for agencies that provide the ESG rating, but probably way more often we see them measured through these metrics that are specific to a company's business. And I have a non-exclusive list of KPIs up here just to call out a few. Sometimes you'll see improvements in energy efficiency ratings of a company's buildings or structures as a KPI, water savings made by a borrower through the use of one of these structures, improvements in conservation, protection of biodiversity. They could even be a borrower obtaining some type of ESG rating or some other certification that's recognized by a provider in this space. So the list of KPIs I've mentioned are all on the G side, G within the ESG, but within one of the later rounds of refinements to the principles, additional social and governance metrics have been added that are up here right now, including improvements in the company's management of its relationship between its business and the communities in which it serves, or the borrower's ability to create and maintain a safe and healthy workplace, for example, or efforts to improve the individuals within the organization's governance committees or compliance committee on the G side of the goal. But these are all targeted to improve a company's overall sustainability profile. And within these structures, the company will receive a discount on its interest rate margin if it meets certain of these sustainability performance targets within the loan agreement. Conversely, failure to meet some of those relevant targets may result in an increase in that margin or some other penalty. So while the use of proceeds itself is not as fundamentally tied to the structure as we mentioned in the green loans, it's still pretty important and a very, provides a roadmap for the company to improve its overall sustainability profile. So very much still tied. But some of the core components of the SLL loans that are promulgated by these principles are, how it selects its KPIs, which must be material and meaningful to the business, the calibration, how these KPIs are used to set the targets, the sustainability targets. I mean, they must be set in good faith. They must remain relevant to the business throughout the life of the loan. And they're really intended to be set as a stretch for the company. It should be something ambitious. It should be something that is not just business as usual, but something that the company, can legitimately say, this is going to, overall improve the impact of the E, the S, the G, whichever principle it is, with the benefit of this loan. Some of the characteristics of the loan we would see there. And then again, much like with the green loans, reporting and verification back to the lender are critical in order for this to be successful. Lenders are increasingly seeing the significance of the borrower obtaining some sort of independent verification of the sustainability factors that are promulgated within the loan documents. And these SLL loans have become there have been a number of them issued over the last couple of years, quite a significant increase, which is why these principles are gaining a lot of focus and attention, because the credit agreements are meant to be rigorous, as I said, a stretch goal for the company, something ambitious, something to reach towards that will result in a meaningful business change. And the next type of loan that I will mention are social loans, similar trajectory as the green loans. These are loans that can take, the shape of a revolving credit facility or a term loan or a working capital facility, but is made in order to finance or refinance in whole or in part an eligible social project. And there are social loan principles that were evolved back just about a year ago. Now as an aftermath of the pandemic, coupled with an increased focus on social justice movements, companies and financial institutions are looking at ways and considering financing projects that would specifically address these issues. A lot of the same concerns and just really components, as I mentioned, with green loans in terms of a process for evaluating the project and managing the proceeds, reporting on the proceeds, and independently verifying the metrics. The investment returns is up there because these facilities are newer in the sense of how they're being tracked and organized. I mean, there is, a lot of these projects don't generate a whole lot of revenue on their own, which is, I think that institutions are looking for more creative ways to track the overall benefit and impact of these projects. So that continues to be key work of the working group that established the social loan principles. And again, much like greenwashing, we do have this element of social washing to be mindful of, and to is certainly an argument for adherence to and participation with the social loan principles that are out there. Just one element of social lending and investing that has been around for some time, but certainly has gained popularity recently, is gender lens investing and lending, which is investing with the intent to specifically address a gender issue or promoting gender equity, which could be directly lending to a women-owned or women-led enterprise, investing in a business that promotes workplace equity, for example. But a lot of organizations have come about kind of just targeting a particular piece of the social investing and social loan market to, target their stakeholders. So have seen a lot of movement in this particular piece of the market recently. And I'll conclude with just saying that in order for there to be success and impact with these loan structures, it's really important that the entire process, from the very beginning of the deal sourcing through due diligence, through the documentation, negotiation of the loan, and even on the post-deal monitoring side, that there's alignment on what the sustainability or ESG objectives are, that the lender's strategy really aligns with that objective, that their vision, that they're set up internally with their policies to receive this, to have the policies in place to measure and track the data and to monitor it, is really critical to the overall success, and where we have seen the most meaningful way to measure the benefits of these structures and the overall impact with the ESG principles. So, as I said, I mean, it definitely it's evolving, ever evolving, and certainly more so on the S and G side than with the E component, which I think we've seen a lot more facilities in place over the course of time. But with that, I will turn it over to Anne to pick things up. Thank you.
Thanks, Penny. My name is Ann Kelly, and I am in the Charlotte, North Carolina office of McGuire Woods in the Securities and Capital Markets Group. And I have been working in the green bond space and social bond space going back to 2012, 2013, as our firm has represented quite a few issuers in the public markets, the public capital markets. So as Penny mentioned in her presentation, the capital market side of this is really focused on green bonds, social bonds, sustainability bonds, a little bit different perspective than with the green loan or ESG loan space. So I am going to focus on really it's really the documentation for these loans, and it's generally contemplating some sort of public offering or maybe a private offering like a Rule 144 offering or something, but just you've got different stakeholders obviously than with a green loan. So green, social, and sustainability bonds, generally these products are distinguished from conventional bonds really only by the targeted use of proceeds to either eligible environmental or social projects or a combination of both of them. A green bond is nothing more than a debt security that is issued by an organization for the purpose of financing or refinancing projects that contribute positively to the environment and or the climate. Sometimes you'll hear these referred to as climate bonds as well, historically especially. Similar to a green bond, a social bond is a debt security that's issued by an organization for the purpose of financing or refinancing eligible social projects, which are those that are designed to mitigate a specific social issue or seek positive social outcomes. A sustainability bond is just a bond that has both green projects and social projects. So it's just a combination of the two, works the same way. Generally, the classification of whether a bond is a green bond or a social bond is determined by the issuer based on what its objectives are. A distinction here from the green loan market that Penny discussed is that there are multiple external stakeholders, the investors, who have a desire to see, some specificity about how your proceeds are going to be used, your proceeds from the bonds are going to be used. It's not just a group of lenders that can assess what you're saying in your loan documents and form their opinions. So here, the biggest challenge is describing in your offering documents what you're going to do and how it's going to work. It's important to understand, is like with the green bonds, green loans that Penny discussed, there's no regulatory process for certifying a bond as green or social or sustainability. Again, it's a voluntary designation by an issuer. So the first green bonds were issued in 2007, 2008 by multilateral or international development banks, such as the European Investment Bank and the World Bank. Really, the opportunity for these bonds to be issued arose because there was a group of stakeholders, group of institutional investors that wanted a way to support environmental objectives through its investing, and hence the development of the green bond by these international development banks. The markets subsequently grew to include other issuers such as corporations, states or municipalities, sovereigns, but those flowed a little bit later than the development banks. According to the Climate Bond Initiative, the global green bond offering market in 2020 was estimated to be about $350 billion US dollars. As I mentioned, because there's no regulation of these, there's no specific, regulations that a company has to follow to say they're issuing a green bond or a social bond. An initial challenge was how to add evidence to the investors that the projects they were supporting addressed climate concerns. A lot of the same aspects that Pitty discussed are applicable here, such as what are the criteria for your eligible projects, how are you going to report on them, are you going to provide impact reporting, is there a third party that's going to verify what you're doing is, quote, green? So what this led to was the development of the green bond principles. You can see that the nomenclature is very similar to the loan space, the green loan principles. These are the green bond principles. And they were developed by a committee of issuers and other stakeholders in the green bond markets with ICMA. So these are kind of published by ICMA. They were initially published in 2014, and they're, as with the green loan principles that Penny mentioned, they are updated frequently, most recently in June 2021. These are voluntary process guidelines that are designed to facilitate transparency, accuracy, and integrity of information that is disclosed and reported by issuers to its stakeholders. The green bond principles have 4 core components. These are use of proceeds, which is really describing the eligible green projects with enough specificity. The next component is the process for the way you evaluate projects and select the projects. The third is the management of your proceeds internally. How is that going to work? And the final one is reporting. How are you going to report to your stakeholders, how you invested your proceeds? So in the green bond principles, for the use of proceeds, they set out suggested green categories, but they are really broad categories and are designed to just be an introduction into more specific projects that an issuer might undertake. They're listed up there, things such as renewable energy, energy efficiency, clean transportation, green buildings, a variety of environmentally friendly projects. The subsequent to the development of the green bond principles, kind of as Penny mentioned with the loan space, the social bond principles followed a little bit later. Those bonds didn't start being issued until much later than when the green bond started. The social bond principles, and then there are also sustainability bond guidelines, have the same 4 components, core components as the green bond principles. And they really work the exact same way other than the suggested projects. So for the social bond principles, it involves both a suggested project category as well as the target populations. So for these social project categories, it might be affordable infrastructure or affordable housing, access to essential services, food security and sustainable food systems, employment generation, socioeconomic advancement and empowerment. Really, very broad, designed to present categories for an issuer to develop and get more specific with. The target populations for a social bond, again, it's a pretty broad category of target populations, including poverty, excluded or marginalized populations or communities, people with disabilities, women and sexual gender minorities, unemployed, other vulnerable groups, including as a result of a national disaster. For instance, during the pandemic, you've seen the presentation of what some call COVID bonds, which are really, they're social bonds that are targeting the impacts of the pandemic. Maybe you're lending to local health agencies that are designed to give them the money to buy the masks or the tests or whatever they need, or develop their technology. And so that's an example of a relevant social project for these social bonds. So this slide at the top, I will say it says social bond principles and sustainability bond guidelines. It should also reference green bond principles. So the rest of the discussion is really with respect to all three sets. So as I mentioned, the biggest challenge is how are you going to describe to your stakeholders why you have a green bond or why you have a social bond. I mean, the concept of greenwashing and social washing is as relevant here as it is in the loan space that Penny was talking about. So, and given that there is no regulation and it's voluntary designation by the issuer, as I mentioned, it becomes a challenge to try to come up with a process that really supports the integrity of this space. So in your prospectus supplement, and I will say, now I'm really talking about green or social use of proceeds bonds. There are other types of green bonds or social bonds, such as mortgage bonds or covered bonds, but I'm not really focused on those in this discussion. I'm really focusing on the use of proceeds bonds, which is when you raise money designed to be used in a particular way that's either environmentally friendly or socially friendly. So in your offering documentation, your prospectus supplement or prospectus, if you're doing a registered offering, or if you are doing a private offering, maybe Rule 144A's offering circular, whatever your offering documentation is, you will, it looks just like the offering documentation for a regular public offering of debt, with the exception of the use of proceeds section. So in the use of proceeds sections is where you are going to describe how you plan to use your proceeds on green projects or social projects. And this is where you identify and address the four core components of the social bond principles or green bond principles. So first, within the use of proceeds section, you address the use of proceeds component, which is really describing your eligible projects. So this is where you will get very specific with saying, and we are going to, if you are a car manufacturer and you're raising money, maybe you're saying we're going to raise money that's going to be used to help us develop electric cars. Or if you are a utility, maybe you're going to say, we're going to be raising money that's going to help us develop this wind farm over here. Or if you're a bank, you're going to say, we're going to raise money and we're going to use that money to lend to projects that are developing, clean transportation or green buildings or whatever it is. So you really define exactly what it is that your objectives are for promoting in these green bonds or social bonds. The next section in your use of proceeds section will be, you will describe your process for project evaluation and selection. Here, the goal is to clearly communicate to your investor the objectives of your eligible projects, the process by which the issuer evaluates and selects those projects to fit their project categories, and also complementary information regarding the processes by which the investor identifies and manages the risks associated with the with the projects. For instance, you might a bank issuer might have a section that says, we will not loan money to, gun manufacturers or whatever it is that you're excluding, specifically excluding from your eligible projects. This process, internal process, is often determined by a combination of an issuer's ESG group, internal ESG group, as well as its treasury function. So those two functions usually work together to identify the projects that are going to be selected for the proceeds for this particular bond. So moving on to the third core component and how you address that in your offering documentation. This is the management of proceeds. This is where you explain that the net proceeds of the bonds, or an amount equal to the net proceeds of the bonds, are going to be credited to either a sub-account or a sub-portfolio or otherwise tracked by the issuer in an appropriate manner. There's you see a lot of distinctions here, but depending on whether it's a holding company raising the money and it's going to be subsidiaries that are using the money. So you describe or you make clear that it is, the money it's fungible, but you describe your process. The process has to be there for you to be able to track it at a minimum an amount equal to the proceeds, and to show that they went to support eligible projects. These management of proceeds can either be done on a bond-by-bond basis. You can say, so for this particular bond that you're offering, we're going to report on it, or we're going to manage these proceeds for this bond in this way. Or if you have a broader portfolio of green bonds or social bonds, you can also manage on a portfolio basis. The key is describing how you're going to do it and making sure you are accurate in that description. Usually you will indicate that your management of your proceeds is attested to by the issuer in a formal process, maybe annually. So the issuer will look at what you've done and how you've used the proceeds, and they will attest to the fact that it's been used the way you said it was going to be used in your offering circular. Another factor that I will discuss a little more in a minute is considering you should consider supplementing your issuer attestation with a third-party review that's similar to what Penny was talking about. So this could be an auditor or another third-party company that just comes in and essentially attests to the fact that the proceeds have been used the way management said they were going to be used. Just another layer of independent verification that helps support the integrity here of the process or calling something a green bond or a social bond. It's not uncommon for an issuer to indicate that the funds are going to be in a general liquidity account. Again, the key is describing how you use an amount equal to that for your proceeds. Also, it's typical to describe that while the use of the proceeds is pending, while the allocation to specific projects is pending, that you will invest those proceeds in, cash or other liquid investments. Again, just being as clear as you possibly can about how those proceeds are going to be managed internally to support these projects. The final category is reporting. So your use of proceeds section will have a section where it describes how the issuer is going to present information on the use of the proceeds. This should usually be renewed annually until the proceeds are fully allocated, and also should be amended on a timely basis if there are material changes. At a minimum, this is a list of the projects to which the proceeds have been allocated, and a brief description of the projects and the amounts allocated to the project and the expected impact. Impact reporting has become more important here than it was initially in the first green bonds. So stakeholders are expecting to see some metrics, qualitative or quantitative, on how the projects that you are supporting with the proceeds that are having the desired environmental or social impacts. Additional key recommendations of both the green bond principles and the sustainability bond principles. External review. As I mentioned previously, part of that is using an external auditor or other third party to attest to essentially the flow of funds, how management has actually used these proceeds to support their eligible projects. Another aspect of the external review that the green bond principles and social bond principles support is having some sort of pre-issuance external review by a provider to assess how the whole use of proceeds by the issuer, the whole section, the projects, the management of proceeds, the selection, the reporting, how it aligns with the green bond principles or the social bond principles as applicable. This is commonly, in the bond market, this is commonly referred to as a second party opinion, although it's not necessarily an opinion in the way that we lawyers think about opinions. There are providers such as Cicero and Sustainalytics. They were the historic primary providers. Now other groups are moving into this space. You might have an arm of an accounting firm that does it, or a ratings agency that does it. But the initial ones were these groups like Cicero and Sustainalytics. The investor base, sometimes an investor base wants to see this second party opinion so that it can make itself comfortable that it is complying with whatever its internal requirements are for its portfolio. So it, again, is another layer of third-party verification that adds to the integrity of the whole process, and the investor can become more comfortable that what you're saying you're doing is really supporting an environmental initiative or a social project. Although this is referred to as an opinion, I mean, it's not addressed to the underwriters or the agents, selling agents involved in an offering. They might rely on it as part of their due diligence, but again, it's just more of a general letter. The second key recommendation of the the green bond principles or sustainability bond principles, that is not one of their 4 core components, but is strongly suggested, is to develop a framework. This is when an issuer develops an internal policy or process that describes the alignment of their bond program, whether it's green bond program, a social bond program, a sustainability bond program, whatever their program is, how it aligns with the 4 core principles of the applicable principles. So this means that an issuer has a document outside of the offering process, which is just called a green bond framework or social bond framework, or however the issuer discusses it, but it addresses the whole program. So it could cover green bonds and social bonds, and an issuer may say, for any given bond, we might do a green bond, and these are the projects we would pick from. Or we might do a social bond, and these are the projects we would pick from. So it puts every possible, everything that the issuer possibly thinks that it might want to support in a project into the framework, and then it describes the other aspects, this project selection, management of proceeds, and the reporting. This is, sometimes it's done in conjunction with a specific offering, or the timing of it is around the time of a specific offering. Other times, it's really done completely outside of an offering. So an issuer will adopt a framework, and the key here is that the framework is published somewhere on your website, somewhere where it's readily accessible. And then when when the issuer does do an offering, it picks from the projects that are presented in the framework. And that's what it describes in its actual offering document, the specific projects it has picked. Often, the second party opinion that I mentioned a minute ago is provided on the framework. If an issuer has a framework, the second party opinion is sometimes on the framework itself rather than on specific bond issuance. But I've seen it both ways. Just to kind of sum up here, in the offering context, I mean, there are a lot of things to consider. As I mentioned, it's all in the use of proceeds section, but because you're offering a security as opposed to a loan, you have to worry about the securities laws, whether you're doing a registered offering or private offering. And that means obviously being very accurate at what you're describing. it also is a key to recognize that the use of proceeds, that use of proceeds section, that is not a contractual term of the bonds. It is completely separate. If an issuer doesn't use the proceeds the way it said it's going to, it is not a default on the bonds. It may cause a PR nightmare, but it's not a default on the bonds. So that's something that's very important to make clear to the investors. That's not a contractual term of the bonds. It may require specific risk factors in the offering documentation, highlighting that fact and highlighting the fact that we're saying these are green projects. We can't assure you that they support whatever your investment objectives might be. We have a second party opinion, but that's not, these aren't regulated, so forth and so on, so that you get some more risk factors than you would typically have in a bond offering. Other things to think about, as I mentioned, you sometimes adopt your framework kind of at the time you're doing a bond offering, but you need to consider these timing issues because you don't want to, or you need to consider whether your framework or a special party opinion, a second party opinion, is going to be used in a manner that constitutes an offer for securities law purposes, or whether it's going to constitute part of the offering documentation, which has its own set of liabilities attached to it. So it's very important to consider those aspects. And another one is for instance, the second party opinion. You want to avoid having the opinion provider being deemed an expert under securities laws. It creates liability. It requires a consent. So, you have to consider these when you're just drafting your use of proceeds and sections. So maybe you are not specifically identifying your third party, second party opinion provider. So it's really just a note here that there are additional considerations when you're involved in an offering of a security to keep in mind. And these green bonds and social bonds, they're not creating new issues. The issues are there. It just requires addressing these issues. So to take away, I would emphasize that the green bond and social bond market is not regulated, as I mentioned. The designation is voluntary. It's made by the issuer. But the market has moved towards the adoption of these green bond principles and social bond principles to provide the consistency in the offering document, and process, and more certainty regarding the green or social objectives of an issuer. And with that, I will end my discussion, and I will point out that we are glad to address questions. If you want to send them over the webinar platform, we can take them away, and the appropriate person, one of the three of us, will get back to you, or you can contact any of us individually. I believe you have our email addresses as part of this document presentation. So please feel free to address any questions, and we would be glad to connect with you and discuss how we can help you. With that, I think we are done.